Hey everyone, and welcome back to another video. In this video we will be diving into why on Wednesdays the market tends to respect the order blocks much more than the fair value gaps and the liquidity pools, which are the buy side and the sell side liquidities. And I will show you how to read the markets more effectively, which will significantly improve your ability to succeed in the long run. So as you can see, we are analyzing the gold. We are on the 15-minute time frame, and I have already marked the order blocks and the buy side and the sell side here. On this particular day, I was anticipating higher prices on gold, as indicated in these screenshots. Here, I was explaining how price action would likely respect the order blocks much more than the fair value gaps and the liquidity pools, which is something I had already factored into my trading plan for the session. In the previous videos, I explained how if Monday was a good day where price clearly respects the fair value gaps and the liquidity pools, then there is a high probability by Wednesday the price will shift and respects the order blocks more instead than the fair value gaps and the liquidity pools. And this is why I emphasized the need to focus on the order blocks on Wednesdays rather than giving too much weight to the fair value gaps or the liquidity pools. Now, the second reason why I was expecting higher prices is that we can see a clear sell side has been taken, and then after reaching to this key level, the markets did a market structure shift or a change in the state of delivery, which I will be talking about that later. And then notice how the prices immediately after making the change in the state of delivery start to reach for a higher prices, which is this key level. And this is the second reason why I was expecting higher prices. So during this session, which is the London session, my expectation was for the price to move higher, targeting this order block and this one and this buy side. However, I was mentioning that if we close above this order block, then we would have even stronger confirmation that the market would set to continue towards a higher prices, which is this order block. As you can see in the analysis, I pointed out that if we genuinely want to see a continuation of the bullish move, we need to close above this order block, and then we can go further to this order block also. And I also mentioned that if a price didn't provide any valid entry opportunity within the first 20 minutes, then the best scenario of action is to wait for the macro time. If you are not familiar, macro time refers to the period between 2:50 a.m. and 3:10 a.m. New York local time, during which the market is more likely to present a high probability entry opportunity. And this time window is essential because it often determines whether the price will continue in the anticipated direction or provide a pullback before the move. So now let's go to the 1 minute time frame and analyze the market. So as you can see, the London session starts at 2 a.m. New York local time, and the price initially moved in a range without a clear direction, and this is where many traders struggle to lose money even when their trades ideas are correct, simply because they fail to exercise patience and wait for the right moment. And this is where experience becomes crucial, because you must learn to stick to your trading plan and avoid making emotional decisions. In my private group, I always stress the importance of trusting your trade idea as long as your analysis is solid. And as you can see, the first 20 minutes went and the prices didn't even give us any valid entry to a higher prices. So what do we do now? Instead of forcing a trade, I decided to wait for the macro time, and the macro starts from 250, which is from here to here, to 310. This period is where the market is more likely to provide an optimal enter to target the higher prices. This is what we were expecting in my group based on the day's setup. At exactly 250, the price tapped into the lower boundary of the 15-minute fair value gap, which is this one in the orange one. Alright, and this is where we saw a change in the state of delivery. So change in the state of delivery is different than the market structure shift. Market structure shift is when you see the candles going like that and like that, and you see there is wicks here and here and here and here, and then suddenly the price, a whole candle closed above this wick, and after taking the sell side in this scenario, then you can call it a market structure shift. But when you see the markets respects the order blocks much more, what you have to do is focusing on closing above a down close candle, especially in this scenario where we were looking for the higher prices. So I was looking to the price to close above a specific candle, which is this one, the down close candle, and then this candle become an order block. And here is why this is a change in the state of delivery rather than a market structure shift. And in this case, after the order block formed, you can see how the price returned to it after closing above, and then the price returned to it, traded and tapped into the order block, and then pushed for the higher prices without any major pullbacks, and then reaching for this old order block that we mentioned on the 15-minute time frame in the blue color. And as I mentioned before, if the price is closed above this 15-minute order block, it will continue to push to the higher prices, which is also to this 15-minute order block. And we saw that the prices didn't continue and then went back to the lower prices. And this is why we were expecting a higher prices on the London session for the 5th of March on Wednesdays. And this is the perfect scenario or example of how you should read the markets and understand that the price moves in a structured way at specific times. Recognizing these patterns and time-based behaviors will significantly improve your ability to predict the market's movements in more an accurate way. And this is exactly why ICT always emphasizes and focuses that time is the most important factor in trading. So that's it for today. I hope you enjoyed the video and found this breakdown helpful for you. If you have any questions, drop them in the comment section and I will make sure to answer them all. See you in the next video.